Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Your drone update. Usually we're with Jeffrey Rosenberg of BlackRock when we're breathless. The Fed's cut rates, blah, blah, blah. Today we pause and we have a quiet, more serene Jeff Rosenberg. He comes in cardigan. He's like casual, It's like not Fed Day or Jobs Day or CPI Day. An intelligent conversation. How hard is it to be at BlackRock and be trying to figure out coupon or total return? Is it a fun business now, or is it brutal every day to make the right decision?
Well, there's just a lot of cross currents, and although it seems kind of quiet, it's about an hour and 10 minutes till we start the morning in fixed income, and then it's ECB day actually. So it never stops. Is the stuff you learned at Tepper at Carnegie Mellon valid now? Is the textbooks help you in this fixed income market? It's a great question, and I talk a lot to new graduates, and I look back on I was the third program at the Carnegie Mellon computational finance program, and what was important is that you learned how to learn. You learned how to keep your skills relevant because, like, for example, when I was there, like, the credit derivatives market hadn't yet even been invented, but the underlying kind of intellectual foundations of that was interest rate derivatives. And so I had the interest rate derivative background. And then when credit derivatives became kind of invented, it was all based on the same kind of academic theories.
I want to get this in quickly. Paul wants to jump in. We've got Jeff Rosenberg of BlackRock with us for this entire 2 blocks into 45 after the hour. I was in the St. Regis Hotel in Beijing, and Gillian Tett did an article on something I'd never heard of, CDO squareds, a million years ago. Are we back to that now with derivative cuteness? Are we doing an 06, 07 redux?
So, it's a quip somewhat attributed to Mark Twain. History doesn't repeat, but it rhymes. And I think that's the way to think about cycles and financial cycles and innovation. Particularly around credit. We've had credit cycles from time immemorial. This one is particularly interesting, right? Because it's in the post-GFC environment where we've seen something we've never seen before, right? This massive expansion of liquidity from a step function change in the role of central banks and the amount of liquidity in the market. And liquidity is the essential ingredient in extending a credit cycle, right? My favorite, probably greatest quip of all time. Hats off to the source of this one, which is coming to a movie, on Christmas Day with Timothée Chalamet. A rolling loan gathers no loss. And what allows you to roll over those loans extends a credit cycle, and that's liquidity. Yep. So this has been a 15-year-long credit cycle. And so you do a lot of things when there are a lot of liquidity in the markets, and you extend, and things build up, and we'll see. It's not history repeating. We're not doing CDO squares. We're not leveraging up subprime mortgages, right? That's why we don't repeat those things, because we look at those mistakes and we fix the past mistakes. But looking forward, you always find new ways to find new sources of
Jeffrey,
yield.
But the best performance year to date in fixed income has been U.S. corporate high yield, U.S. leveraged loans, up 8-9%. I mean, do I take that risk going into 2025? Do I take that credit risk going into 2025?
So we're at almost through. Depends on which metric you look back in terms of history, but we're at or close to the tight levels of spreads observed in those markets. So you can take that risk, but you've got to understand what your distribution of outcomes looks like. It's a carry trade. It's an income trade. Mm-hmm. Now, why are the spreads so tight? Because corporate balance sheets, corporate profits, despite all the back and forth about what is GDP doing and what's inflation doing, corporate profits have powered through. So with the inflation story, what has happened is pricing power.
Yep.
And so corporate profits really are what are driving corporate risk premiums. And there's one other thing that's really interesting happening in this market about Tom's earlier question in terms of innovation is kind of what you're measuring in the public markets is changing because we're redistributing the balance of credit risk between bank underwritten credit that stays on bank balance sheets, public credit markets that we measure in those indices, and then the types of credits that are being increasingly found underwritten in the private credit market. And that distributional change makes some of those historical comparisons a bit different. But the bottom line is spreads are very tight. Could they go tighter? Maybe. But you should expect that your carry is going to be the best case scenario. And that if there's any kind of surprise to the downside, you're going to be looking at some price erosion from spread widening in the 2025 outlook.
What does your Federal Reserve do on December 18th?
Oh, wow. I think if we pull up the Bloomberg function WIRP in Cincinnati, you will. It's radio. That was a radio joke. Hopefully everybody
He's
got it.
auditioning here. Should I just see you, Tom?
So I think it's 100% or 99% expected. So the Fed is kind of backed itself into the corner and doesn't want to disappoint market expectations. But you look at that inflation print yesterday, you look at the ease of financial conditions. Tom, you've seen me say this on every FOMC, every payroll meeting, that the disconnect here, and it's been a disconnect for a long time, is the disconnect between the Fed's view of how tight policy is and how easy policy is when you measure it by financial conditions.
On the ambiguity of our economics, Jeffrey Rosenberg with us with BlackRock this morning. Rates go down, it's ambiguous. Does it goose GDP, or is it a question of a slower demand? You go down, you get China deflation or massive disinflation. When you see rate cuts like we see, which of it is it? An attempt to goose GDP or a desperation towards deflation?
So I think for the impact on the U.S., the Fed wants to normalize, and they think that they're tight. I wrote about this at the beginning of this year, and it showed up when the Fed finally cut rates by 50 basis points in September. And I called it the new conundrum, right? So you guys will remember the old Greenspan conundrum, right? Then he was raising rates, but long-term rates weren't going up. They were going down because back then China was reinvesting all of its trade surpluses back into treasuries. And we couldn't understand why the Fed couldn't control long-term interest rates. So I've talked about the possibility that we could see the new conundrum. And what's the new conundrum is here we're cutting interest rates in the short end, but the long end isn't responding. That's exactly what happened in August, right? We cut interest rates 50 basis points. The long end went up. And I think when you look into 2025, right, we've taken down the amount of cuts that the Fed is expected, but they're still expected to cut rates. And if they do, and this is what yesterday's inflation print is kind of worrisome, is we're kind of getting into the consensus around this sticky inflation. Okay, so why are they cutting next month? Next week? Because they want to support the job market and they're concerned about the tightening. So they're showing their hand that there's a little bit of preference for the labor market over the inflation view. Okay, well, that's a problem for the rate cutting cycle because you can cut the front end, but the back end may be more worried about that sticky inflation and worried about some of those longer term issues around debt and deficits and the fiscal policy side. So the rate piece could get very interesting next year where the directionality on the Fed doesn't necessarily create the directionality for the bond market. And remember, most of the bond market returns are going to come from the longer end if you're holding, say, an ag or a typical kind of index portfolio. So kind of thinking that your returns are going to follow what the Fed is going to do in 2025, kind of like what we saw in October, maybe a tricky and problematic way of investing in fixed income next year.
Coming in January, we got a new administration coming in. We have a new Congress that's going to be seated. Did that change the way you guys think about opportunities, risk, reward?
Yeah, I mean, I think we're all kind of going through, it's that time of year, 2025 outlooks. No,
don't tell me you did an outlook.
No, I spare myself the December outlook. But come January, we write here's what we think for this week. And it's basically, this tremendous amount of policy uncertainty. And which policy uncertainty gets unwound or realized first? right? And so the problem is the stuff that can be done quickly, trade, immigration, is the stuff that has a little bit more worrisome uncertainty for the economic impact, and the tax pieces and the deregulation takes a little bit longer to play out. So you have a timing aspect for how this kind of policy uncertainty unwinds in the first part of the year. And right now, no one really knows where that's going to shake out, and it's creating this kind of policy overhang of uncertainty. But what we've seen obviously in financial markets is kind of the post-election reduction in the pre-election uncertainty that's leading to kind of reduction in volatility, kind of what you might call the everything rally.
So what am I doing on credit? I mean, I could sit here in a 2-year at 4.2%. Do I take credit risk here?
So you can take some credit risk, and as I was saying in the kind of the earlier segment, that the credit risk, you want to preserve some flexibility. You want to preserve some ability to change your portfolio because you really don't have a lot of upside in terms of price appreciation. You don't have a lot of downside when it comes to kind of the base scenario for 2025. The economy's doing well, corporate profits are doing well, but you have a lot of that reflected in the price, right? So you just don't have a lot of good asymmetry on your side. So you want to kind of start the year with a little bit of flexibility. You can own credit here, but I wouldn't be max overweight into my credit position at the beginning of the year.
There's a belief out there, I'd say, in the zeitgeist that the big companies that are riding high right now won't issue credit until rates come down. I don't buy it. That's a consensus view. Is the big surprise next year they're all going to start issuing?
So you got to separate kind of discretionary issuance, which is what I think you're talking about, like where do corporations have the ability to show some flexibility? And remember, like the average maturity of investment grade debt is like 7 years, right? So you've got 15% of that debt coming due every year. So there's just this kind of recycling effect where you're getting issuance because it's just part of the natural.
But then will we get an
recycling.
overlay on top of that?
Yeah, and then the overlay on top of that, you will get some of that because the credit spreads are very tight, so there's very good kind of pricing power. Never mind the rate aspect. The rate aspect is a little bit tougher one to time. So it's really when you see kind of issuers pull back and add, are they getting really attractive issuance on the spread side? And right now they're going to get very attractive issuance on the spread side.
You should see when Mag 7 sends around to all the houses their Christmas gift thing, the holiday. You should see the fruitcake Rosenberg gets.
My God, BlackRock.
It's just unbelievable, the fruitcake.
The first call I make. All right, so where's the best value in the fixed income space today as you think about 2025?
Yeah, so I think there's value and there's kind of opportunity. And so I think the value is in the front end of the curve because that's the part where I think if you're going to see some kind of reaction from the Fed's policies in 2025, that's where you're going to see it. And you're not as exposed to what I was highlighting earlier before, this kind of conundrum risk where Fed's cutting rates, but back-end rates are really reflecting more long-term inflation or debt and deficit issues. Value is tough across fixed income because of the tightness of spreads. So it's really about relative value and relative kind of risk exposure. Front-end investment grade, there's not a lot of spread, but there's not a lot of risk. So it's kind of an okay place to be. There's no real kind of jump up and down and back up the truck. As I said before, it's more about a little bit starting the year, a little bit more flexibility, a little bit more liquidity, a little bit more defensive on how tight spreads are, and then use that to take opportunities if there's some surprises, which is what we're going to get, right? You just can't predict them by definition. That gives you an opportunity to take advantage then.
What are systemic strategies? That's in your
Systematic.
title. Systematic. What's the difference? Tell me. What do you guys do?
Yeah, so basically the key of what we do is to exploit opportunities in the cross-section, right? And look at alpha opportunities. And what we do is take out, so much of what we talk about in the markets is the direction, right? Are rates going up? Are rates going down? Look, the reality is getting the direction right is pretty hard. So if your alpha source, if your outperformance source is betting on direction, it's you get maybe 4 times a year to make that correctly. If you look inside of financial markets, inside the what we call the cross section, there's a lot more opportunities to take advantage of the key driver of alpha, which is dispersion, and that's kind of like the centerpiece of our systematic strategy.
And over to equity markets, folks, what you just heard from Mr. Rosenberg is gospel. I can't say enough how wrong the financial media is on this, of focusing on vectors out 6 months. They change like an aircraft carrier turning around in the Mediterranean, and the grind is day by day looking for that differential in price, which if you're at BlackRock, you got to use Greek letters. I mean, you went to Carnegie Mellon.
$300 billion doing this system.
He named his third kid Epsilon. I mean, what's that about? Jeffrey Rosenberg, thank you so much.
Thank you very much, guys.
Wonderful to have you in studio. And particularly, this was great. It's not like, what did the Fed do? What about paragraph 3? I mean, it's just it's a different Jeffrey Rosenberg.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
There are people that said rates are going up and inflation's not going back to a John Williams 2% too quickly. Jim Bianco out front. I thought Dr. O'Leary's done a great job. The Citigroup Combine, Hollenhorst and that crew.
They know what they're doing.
Great job. And other people that, the small brain I have it without the Sanka going. But Lindsey Piegza is the one that day after day after day just said, shut up. Inflation's not coming down. She's my Economist of the Year with Stifel. Dr. Piegza joins us this morning. Lindsey, the global rate cut, the race to the bottom, is it about trying to goose output, or is it a modest panic about, as David Rosenberg says, too much economic capacity, that there's not enough demand out there, rates got to come down now finally?
Well, I think we're seeing very diverging economic conditions, which warrant different policy for the ECB, the Bank of England, versus what we're seeing from the Fed. We're seeing faltering growth overseas and a much more precipitous decline in inflation. Here in the U.S., growth is averaging near 3% over the past 6 months, and inflation is not showing further improvement, but rather momentum to the sideways, and in some cases, an acceleration in some of these key components.
Right.
So this divergence is very much to be expected, given that differential in economic and underlying conditions that we're seeing abroad versus in the domestic economy.
Up at Harvard, Jason Furman does a great job. He calls it his ecumenical inflation, as he combines all sorts of series. What is your ecumenical treatment of yesterday's inflation report? Can you see a disinflation vector?
Well, I think at this point, there was not enough momentum to the upside to dissuade the Fed from that December rate cut. I do think the committee is going to push through a third round cut next week, given that the increase was in line with expectations. Remember, Fed officials have reset the bar for December, saying as long as the numbers are within our expectations, within our forecast, that's not enough to derail our progress towards further relief for the economy, as long as the economy is still strong and solid but not overheating. So the threshold has been adjusted higher for December, but going forward, if we continue to see inflation at these elevated levels, this lack of progress, as we've seen in the core now for the past several months, I think the Fed is on the verge. They're going to be backed into a corner to take that policy pause sooner than later in the new calendar year of 2025.
Lindsey, we're going to have a new administration coming in next month, a new Congress to be seated. Are you concerned about some of the, we haven't heard much about the economic policies of the new administration, but I guess tariffs are certainly part of it. Tax cuts are part of it. Does that raise materially your inflation concerns in this economy?
Well, it certainly raises the risk scenario. We don't necessarily know how these policies are going to impact the economy, how these policies are going to impact from an inflationary standpoint, because we can't look at them in and of themselves. Large, sizable tax cuts could be inflationary, but we've heard from the incoming Trump administration they're likely to be offset with large, sizable reductions in government spending elsewhere. And so it depends on how this net plays out from an inflation standpoint, just like tariffs. In and of themselves, not inflationary. But if we see the economy engage in a tit-for-tat retaliatory cycle of consistent increases in tariffs, that then could lead to inflationary pressures. So there's still a lot of question marks, but I think it does raise the upside risk, which in part is why the committee wants to force through as much policy relief as they can now, before they face that potential downside limitation due to fiscal policy restraints.
Lindsey, our economy's 70% services here. How's the consumer doing from your perspective?
Well, the consumer is proving surprisingly resilient. We continue to see consumers out in the marketplace spending on goods and services,
Wait a minute. Lindsey, you nailed this. Go back 6 months. How did you guess that the consumer would be resilient? What was the pixie dust where you said the gloom crew's wrong?
Well, I think the majority of the analysis was looking at the primary support for the consumer during the pandemic and the immediate aftermath stemming from fiscal stimulus. We pumped trillions upon trillions of dollars into the marketplace. And with that stimulus largely concluding, the notion was the consumer has to fall off a cliff. We haven't seen it yet, but the consumer has to be marching towards that endpoint. And I thought, not so fast, because there's a number of variables that are continuing to support the consumer. During the pandemic, we weren't just buying Pelotons. We were also paying down credit card debt. So the consumer's starting point from this deleveraging allows the consumer to take on a good amount of additional leverage, additional borrowing power, which will continue to supplement the consumer as we've seen.
Okay, so bring it forward. We're running out of time, but this is important. Bring it forward to Paul's good question. Does the Piegza consumer boom continue?
Well, the consumer continues to spend, but at this reduced level of about 2.5% to 3%. Now, certainly nothing to sneeze at, but it is a loss of momentum from a more robust pace, as we've seen over the past year plus.
Right.
So the consumer is still the backbone, still the bright spot of the economy, but there is a potential for a loss of momentum, but that's not accounting for a potential change in policy if we do see sizable tax cuts or other supports for the consumer from the incoming administration.
So give me this summary here. The Fed's going to cut rates in December. Do they not cut again until the Red Sox win 5 games in a row?
Well, I can't necessarily speak to that timeline, but the Fed will likely cut rates in December and then stay on hold for at least 2 meetings, for at least some portion of the first quarter. We're looking for just 1 rate cut per quarter, totaling 3 additional rate cuts next year, taking us to 3 3/4. That's 375, and that's a good neutral level for the Fed to target.
We'll talk again soon. Lindsey Piegza, thank you so much for Stifel, just absolutely nailing the growthiness that has surprised all this year.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm looking at Gautam Mukunda, and I'm doing selfies with him, Yale School of Management. And of course, down in the New York Stock Exchange right now, the president is working the floor. It's like he's selling takeout at McDonald's. He's going from floor to floor. You know who's missing here? Art Cashin.
Yes, exactly right.
Art Cashin would, he'd say like, Mr. Trump, would you like a selfie with me?
Yeah,
and
exactly
Mr.
right.
Trump would be honored.
Absolutely.
The late Art Cashin missed at the New York Stock Exchange. The president-elect ringing the bell, and of course comments made a half hour ago with the Secretary of Treasury designate assembled as well. We get perspective on that event and the event forward known as the second term of President Trump from Gautam Mukunda, Professor, Yale School of Management. Is this going to script? Do you feel like this is, it's not Grover Cleveland Alexander, but do you get the feeling into a second term it's working out?
Well, it depends on what you mean by working out. The script is what I think a lot of people anticipated, and so far,
his comments this morning were sort of on script.
They were on script. They were normal, and I would say there are 2 scripts. There's the public script, I'm going to be a relatively normal mainstream Republican script, and there's going to make some big changes. And then there's the other script, which is Pete Hegseth, Kash Patel, people like that. Steve Bannon and Steve Miller returning to positions of power. That's the other script. And that one also seems to be proceeding forward. Now, which of those 2 scripts will be dominant for the next 4 years is kind of the ultimate question, but that's going to decide a lot of things.
How do you think this U.S. Senate is going to deal with some of the more controversial nominations for cabinet positions by President-elect Trump?
That's the big question. Opposition seems to have focused in on Pete Hegseth, largely because every week there seems to be another new Pete Hegseth scandal, and they seem to be worried that there's more coming out. It looked like he was in a lot of trouble up until a couple of days ago when Joni Ernst kind of surprisingly said, well, I'm pretty open to him, clearly in response to a lot of pressure from the movement. If he's confirmed, it's hard for me to imagine who won't be, because given just the number and quantity, and just the fact that the Defense Department employs over 2 million people.
Wow.
Pete Hegseth's last managerial experience ended when he was forced out for mismanagement and being drunk in office party. Like, this is a problem. So if the Republicans are willing to bite the bullet and confirm him, it's hard for me to see who they wouldn't confirm.
The book is picking presidents. It was important in October and into November, and maybe just as important now. I guess we have picked a president. Like all presidents, he will become overcome by events. Is Syria big enough where it's his first overcome by events?
So Syria's huge, and he's going to get, however isolationist you want to be, he's going to get deeply acquainted with events in Syria. And as Tom Friedman said that today, countries in the Middle East tend to either implode or explode, and Syria seems like it's in an explode phase, which will certainly ripple through. But I wonder how much his own tendencies towards disengagement will push in. He'll sort of say, look, if there are more refugee flows, that's not our problem. We're sort of stable. I would be more suspect that the thing that will draw him in is Ukraine. Ukraine is too big to be ignored, and it will just pull him in over and over and over again, because pressure to make a settlement, that's just not going to come easily. The two sides are so far apart on what they would demand that absent Trump essentially forcing the Ukrainians to surrender, which I cannot actually imagine him doing just because of the political blowback that he would feel. I'm not sure how he avoids getting tangled up in that.
It's been a long time. I can't remember when we had a president come in for a second term, not, sequential.
Grover Cleveland only happened
Thank
once.
you very much. Is this a lame duck presidency?
Yeah. So the analytics that's really interesting is we're seeing a contest of two forces here, and for the sort of control of the Republican Party. So one, the reason that Matt Gaetz went down, the reason you saw initial opposition to Pete Hegseth, and I think the reason you're going to see a lot of people who are looking at Kash Patel and going, come on, is going to be that for the first time since Trump took the Republican nomination in 2016, Republicans don't need him anymore, right? And need defined as we need to get reelected. So if he is not going to be on the ticket in 2028, absent sort of massive changes to the Constitution, and so they cannot say, well, I have to live with this or I have to support this because I need him. That story just went away. The flip side is his control over the base of the Republican Party has no precedent. He is more popular with Republicans than Eisenhower or Reagan. We have never seen anything like this. And the blowback of Republicans to stand against him is very real.
I got to sum this up, and we've only got 1 minute left, or a minute and a half. But Gautam, Professor, this is so important. Apple went public 1980 today. On the Bloomberg terminal, this is from 1982. I had Grandpa Sweeney bought you 100 shares, Paul?
Yep.
$3,200.
Okay.
Apple, 100 shares, $32 per share.
Yep.
Split adjusted. With the dividends of $196,000, your $3,200 is now worth $213,000, nice. 20% per year. That's what the president-elect was talking about. Maybe not that articulate Bloomberg way, but that's the experiment, Professor, right?
I mean, if we could all deliver that, one of my best friends is one of the world's best-selling fantasy novelists, and he bought Apple the day it went public. I asked him if he made more money off one of his books or Apple. His answer was the books, but it's a lot closer than you would think. But I mean, the basic problem here is we know that labor markets are sort of as tight as they can be. We know that the Fed will respond to faster economic growth by raising interest rates. We see that inflationary pressures have not gone away completely, and on some basic level, there are surely hard limits to the U.S. economy that mean that we couldn't possibly do 20% a year, wonderful as that would be. I would love to see what will really happen, and to me, where that growth trajectory will really come from is we're looking at biotech, and that places in there that there's that sort of deep technological progress that has been building for a generation, and you're starting to see the S-curve bend.
Right. We're going to talk about that tomorrow, folks. Tomorrow, an extended conversation with Gene Munster and Dan Ives on this technology moment that we're seeing across America. I've seen a couple essays here in the last 48 hours just saying this embedded, not AI, but is embedded technology lift that we're getting is really quite substantial. Gautam Mukunda, thank you so much, with Yale School of Management.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg terminal.
Taking a look at the front pages, it's the Lisa Mateo minute. Okay, take more than a minute.
Wait
Lisa,
a minute. I went from an hour to a moment to a minute.
Al from New Jersey emailed in and said, you got to give her less than an hour.
Here we go. Okay, I want to start with Netflix because there are reports that it's walking back its parental leave policy. This was in the Wall Street Journal. So about a decade ago, Netflix announced that it was offering new moms and dads, Paul, you're going to love this, unlimited time off in the child's first year, okay?
18 years.
But a lot of more staffers took advantage of the benefit than they thought. So the Wall Street Journal, they spoke with workers, former workers, who say the company spent the last few years kind of stepping back. They haven't taken it away per se, but they're offering vague, conflicting guidance internally. The reason why the company's been growing, right? They now have like 14,000 employees, more than 60% jump from before the pandemic. So, so they have to start making some changes.
And I think it's Wall Street focus on profitability, not just growth.
True.
So I think the company's saying we need to look at all of our costs here. And if
when your first kid was issued, how many days did you take off?
I had twins, and my
how many days did you take off?
I was back on the road the next week.
I took 3 days off.
Twins.
From cash flow. Cash flow came out. He was issued, and I took 3 days off. And granted, that's stupid.
It is. I'm not saying it's
completely stupid.
No, it was.
But come on, Lisa, how long should maternity leave be, or paternity leave?
It's tough. I know I myself only had 3 months, and then I had to take vacation days. So it's different.
It's much better now.
Different everywhere you go.
It's much better now. And like here, I think we have a very good policy.
We have an excellent policy here, and even dads are included.
Excuse me, do you want to tell us something here? Is there something we need to know?
I am way past that. That ship has sailed.
Next.
Okay, reality TV shows. I'm not sure if you guys are fans of any reality TV shows, but Netflix has one. It's called Love is Blind. The reason I bring this up is because the National Labor Relations Board has brought up this complaint, and it could start allowing them to become union members. We're talking about the castmates of these shows. Okay, it gives it because they're talking about different federal legal protections, opening the door to unionization because it classifies the show's contestants as employees. That's what they're trying to fight. A lot of the contestants have been fighting this. There's been lawsuits back and forth about this, but it's this particular show that's kind of starting this and opening the doors to other shows and saying, hey, wait, maybe we should start.
Well, one of the reasons that the broadcast networks and the cable networks like reality programming is it's much lower cost.
There's no script writing.
There's no script, any of that kind of stuff. And since there's less advertising revenue because of cord cutting, that's all you're seeing on broadcast television these days on the networks are these reality shows. It's very rare that you see a scripted show on the networks these days because they're just too expensive.
Season 7 was really, it started slow.
Of Love is Blind?
I mean, perfect husband, but, and, you know, the tables have turned, but then I love in week 2 where they had dirty laundry. I mean, you know, it was just a great episode.
I have to be honest, I didn't know what this show was. Apparently, like, they date one another from separate rooms. They don't even see one another. They hear it through speakers until they agree to get engaged.
Give me happy days at 8 o'clock on Tuesday.
John Farrell's the one that turned me on to Love is Blind. It's his fault. Next.
Okay, Sports Illustrated coming to a stadium in New Jersey. Okay, we're talking soccer. They're buying the naming rights to the 25,000-seat soccer stadium right near Newark. It's the home of the Red Bulls.
Yeah, it's a great
home of the
stadium.
Gotham. Yeah, great stadium. I've been there for a game. 13-year deal, reportedly worth more than $100 million. But the only thing is that it has little to do actually with Sports Illustrated. Because if you know, they're owned by Authentic Brands Group, which kind of buys up companies that are under pressure, sells the licenses for the use of their names.
Do they still make the magazine?
They do still make the magazine. They're just not making as much money, I guess. But that's why they do agree to go with Authentic Brands, because now this company gives them money because it helps sell off to the use of their name. So
similar thing with Playboy, by the way. Just throwing it out there.
They did that too. Okay.
Having covered that stock for many years.
but it's also owns Sports Illustrated tickets. And I just bring that up because now that ticket company is going to be the exclusive ticketing partner of the team. So that's another difference.
30 seconds, speed. What do you got?
Okay, last one we have. The price of groceries, sky high. So what's the solution? Well, there's someone running for New York City mayor. His name is Zohran Mamdani. He says that we should think of doing city-owned grocery stores. That's what it is.
Oh boy.
He says it's going to help bring down the cost of groceries because they're going to use city land or buildings, buy food wholesale, and would also be exempt from property taxes.
On those margins, I don't get
I want
it.
the city involved in anything.
I don't get how they do it given the income
It's
statement. of the
Kansas,
industry.
Wisconsin are doing it.
Really?
They're trying
Really?
it out.
Oh, okay.
Yes, Chicago, Atlanta, they're moving forward with similar proposals. So it's going to be brought up today. This
right.
this lawmaker. Yeah.
Lisa Mateo, the newspapers.
Bread lines.
Thank you so much.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.